Have you ever stared at a screen trying to buy some company shares, company stock, and wondering whether the price is right? Well, fear no more. Today we're going to talk about stock valuation, equity valuation. Welcome to My Finance Teacher, and today the company valuation, stock valuation is going to be somewhat different from the regular sort of valuation we look at. Usually we look at valuations of mostly gold mining companies, in which case we have an exhaustible resource in the ground. That's what the companies have to work with. By the way, the link to the most recent valuation of two of the largest gold mining companies in the world is at the top of your screen right now. Today though, we're going to talk about valuation of a general business that can continue operating without relying on an exhaustible resource in the ground. The model that we're going to use is basically the dividend growth model. And to start with that model, we first want to ask ourselves, why do we buy shares? Why does anybody buy stocks? Well, that's of course to make money. That's a form of investment. All right, having bought the stocks, what are the actual sources of cash coming back into your hands from that investment? Well, one type of cash generated by this investment could be the dividends, and another type of cash generated by this investment could be simply selling the stock back at hopefully a higher price. So for the sources of cash, we have the dividends and selling the stock back. So your total return would consist of some of the dividend that you received while holding the company stock for, let's say, a year. So you bought the stock for the price of P0 at the time, 0, held it for 1 year. During that time, you got a dividend. Let's call it D1, 1 year dividend. And in addition to the return in dividends, perhaps you sold the stock, hopefully at a higher price than the original price. Let's call that new price P1. So in percentage terms, if I divide the dividends and the new price by the original price of P0, the sum of these two components is going to give me a total return, with the first one being called the dividend yield, and the name of the second component is capital gains. Now, with a minimum requirement for your returns based on how risky investing into the company is, and perhaps based on some expectation for the dividends going forward, as perhaps promised in the company's annual reports, you might probably form an idea of the maximum price that you're happy enough to pay now for the company's stock. Again, let's call that P0, and your minimum required return, let's just use R for that. In that case, some sort of a maximum price that you're happy enough to pay for the company's stock would depend on the dividends you expect. You of course would want to discount those dividends based on the level of risk and the minimum required return. And similarly, the price that you might receive in future, you perhaps want to discount that as well. We do the discounting by dividing the future cash flows by 1 plus the required rate of return into the power of a number of years that I have to wait for that cash flow. Now, how about this P1, the price that I might sell the stock for 1 year later? What will that depend on? Well, let's think about it. Why would the next guy buy the stock from me? Again, to make money, and the sources of cash are still the same. Dividends and reselling the stock perhaps again 1 or 2 or a few years later. In that case, that future price that the next guy will be kind of happy enough to pay will depend on those future dividends. Let's say he is going to hold the stock for a couple of years, receiving the dividend D2 plus the dividend D3. All of that should be discounted to determine a fair price that the next investor is going to pay. And another source of cash for him is reselling the stock, perhaps in year 3. But why would the next buyer buy the stock? For those same reasons. She wants to make money as well, and that price that she is going to be happy enough to pay will depend on the future dividends and the future price. So what we can do here is, instead of P1, in my own thinking for a relatively fair price, I might substitute that with the dividends in year 2 and year 3, as P1 will depend on those. And instead of P3, again, I might substitute all the future dividends into the formula, giving me basically some sort of a fair valuation for the company stock that depends on all the future dividends going into basically as long as the company exists. So there you go. To find the fair price, we just discount all the future dividends going into infinity. That, of course, is going to take ages. So there must be other way. And to simplify our calculations, we have to make some sort of assumptions of the dividends going into the future. And we're going to make three assumptions. One being that the dividends are going to be constant or they aren't going to grow. Another assumption is going to be that the dividends are going to grow at a constant rate. That is also going to simplify things to some extent. And a third assumption is that even if dividends are kind of erratic for a period of time, they do go back to constant growth rate after a number of years. In that case, we'll have to discount these erratic dividends one by hand, and for the rest of the dividends going into the future, would be able to use some simplification formulas. In case of the first assumption, with a constant dividend, zero dividend growth, the stock valuation is kind of similar to the valuation of perpetuity, those bonds that never expire, as for companies, we don't really expect company life to be particularly limited. So the fair price today is simply a ratio of the fixed dividend that the company pays per year divided by the annual minimum required rate of return. Let me quickly highlight this formula and let's have a look at this example, where a stock is now selling for $29.65 on the market and it pays a constant dividend of $3. If you think that the required rate of return for this level of risk associated with this company is 12.5%, how much do you think is a fair stock price, and should you buy the stock at the current market price? To calculate that fair price, the valuation, just divide the $3 by 0.125, that's 12.5%, giving you only $24 fair valuation for the company, meaning that the current market price of nearly $30 is perhaps overvalued, perhaps a bit too expensive, and maybe you don't really want to buy this stock at the moment. Our next assumption about the dividends was that the dividends grow at a constant rate. Let's call this dividend growth rate letter G. And as you see, the dividends in future years will simply be the original dividend at time 0, D0, multiplied by 1 plus that growth rate into the power of a number of years. And from a perspective of an investor into a given stock, it's usually assumed that D0 is not received by the current buyer. D0 is just the most recent dividend paid, and let's just assume that the buyers will start receiving dividends starting from D1. In that case, that very long formula with many infinite number of dividends is reduced to this more manageable form, where the stock valuation, the fair price, is the ratio of that next dividend D1 to the difference between the required rate of return and the growth rate of the dividend. And of course, alternatively, we can replace the previous dividend times the growth factor instead of D1 as well. This is actually a pretty useful formula, so let me highlight this one as well. For a quick example, let's say we have a company that has recently paid a dividend of $1.40. The dividend is expected to grow at 4% indefinitely, and let's say the required rate of return for this company is around 8.5%. What would be your stock valuation, a fair price? One thing to pay attention here is what sort of dividend are we looking at? Is it the previous dividend D0 or is it the next one D1? We don't want to make a mistake here, and the rest, of course, is going to be pretty easy. In this case, recent means the previous dividend, so we're going to use this part of the formula with D0, multiply that by 1.04 and divide by the difference between the required rate of return and the growth rate of the dividend, giving us a fair value of around $32.36. And alternatively, another example where we look at the next dividend, which is equal to $3.20. Let's say the dividends are expected to grow at 2% and the required rate of return is the same at 8.5%. How much is the fair price? That's simply the ratio of that next dividend D1 to the difference between the required return and the dividend growth rate, giving us $49.23. And one other interesting thing we can do with this formula is actually derive the market required rate of return for a company given its market price and dividend expectations. For example, let's say we have a stock that is traded on the market at $62.33. The recent dividend was $5.50, and the dividends are expected to grow at 2% per year. How much is the required rate of return according to the market right now? To find that out, we simply rearrange this highlighted formula for the required rate of return. Again, we should pay a bit of attention of what sort of dividend is given in the problem. In this case, it's the previous dividend or last dividend. So we multiply that by this growth factor, 1.02, divide by the stock price, and add back that growth rate again, 0.02, giving us an 11% required rate of return. And sometimes for more details, we might actually use this increase decimal button on Excel to see what exactly are we looking at. And finally, for the third assumption, let's imagine that the dividends are erratic for a couple of years, and after year 2, beyond that, the dividends are expected to grow at a constant rate. For example, let's say we have a stock B, which recently paid a dividend of $4, and the dividend is expected to grow by 10% into next year and by another 15% into the year after that. Starting from 2 years from now, starting from year 2, the dividends are expected to grow at a constant rate of 3%. If the required return is 14%, how much is fair stock price? What we do here is we basically break down this timeline into two sections. The section where the dividends are erratic, and the sections after year 2 where the dividends are growing at a constant rate. We first calculate the share price 2 years later, let's call that P2, from the perspective of the investor who would buy the stock at that time. From that perspective, the dividend is expected to grow at a constant rate, so we can use the formulas that we've just discussed. In addition to that, we'll have the erratic dividends to have a look at, and what we have to do is we have to discount them one by one manually into time 0. We will also discount P2 into time 0, and the sum of all of those discounted future cash flows is going to help us find the fair price today. So first, let's start with the fair price after 2 years, P2. This highlighted formula can actually help us. If I turn this P0 into P2, the only thing I have to do is just add 2 digits to the lowercase indices here. So the third year dividend divided by the difference between the required return and the constant growth rate will give me a fair price at year 2. So let's find the dividends after the first, second, and third years. If the original dividend is $4, then the next dividend is $4.4, that's 10% higher. The dividend 2 years later is another 15% higher, giving us $5.06. And that's the time when the dividends start to grow at a constant rate of 3%. So the D3 is going to be another 3% higher, giving us $5.21. Now we can plug the numbers to find price after 2 years. The discount rate is 14% and the growth rate of the dividend is 3%. That is going to give us a price of $47.36, which will include the value all of the future dividends beyond year 2. So to find the fair price today, we simply add the discounted value of the dividend after year 1, the discounted value of the dividend after year 2, that's generally into the period where the dividends are erratic, plus the discounted value of the price at the end of this erratic period. The discounting is of course dividing the cash flow by 1 plus the discount rate into the power of number of years of that relevant cash flow. P2 and D2 happen at the same time at the end of year 2, so I can add them up, divided by 1.14 into the power of 2. And that finally gives me a fair value of $44.20 today. And lastly, to generalize, when we have erratic dividends for a period of time, perhaps sometimes 0 dividends, with the dividends going to a constant growth after that period of time, The first thing we need to do is find that dividend 1 year into the constant growth rate, which will help us find the price at the end of that erratic period. Then we find those erratic dividends. Perhaps those are based on percentage changes. And the last thing we do is we simply discount each of these separate cash flows back to today for P0. I hope you find this video interesting and even a little bit useful. If yes, remember to hit that like button, share this video with your friends, and subscribe to the channel. For now, good luck on your exams.